Hello, this is Paul Gregg. I'm back for session 4 of the Mathematics of Wealth, talking about the time value of money. And today we're going to talk a little bit about college, whether that's a good idea to go in debt for, and a little bit about taxes. We've established that the time value of money means you need to earn interest rather than pay interest. But we talked about one case where it's probably good because it's an investment. A home is a good investment, and so a home is as good as a savings account in a lot of respects. So there is one time when I'm thinking it's okay to go in debt. That's for a home. There's another time that some people go into debt for, and that's for an education. My opinion is you better be very careful about this, because going into debt for anything is a difficult thing, and you better have a return on your financial investment. So is it worth taking out a college loan? This is how much University of Washington costs here in Washington State. The tuition is really not that bad compared to, it's still high. Resident tuition, $11,500. But there's a lot of things that add up, the cost of living and room and board and that kind of stuff. Now, you don't have to spend that much. You can live cheaper and eat cheaper, but you got to live and eat and study. You can also have a part-time job, but that could affect your studying. So, like anything, there's a lot to it. If we go back to calculator.net, there is a student loan calculation. If you're going to get a student loan, if you can at all not get a student loan, then you shouldn't do it, especially for certain aspects of it. If you just paid for University of Washington tuition 4 years and lived there and didn't work, didn't have scholarships, didn't have any grants, you'd spend $35,000 a year, and that would total up over 4 years to $140,000. And at current interest rates on a 10-year term, we like to, if we're going to borrow money for school, we like to pay it off relatively quick. And you went to school, so your salary would be higher. So you should be able to do that. But still, if you borrow $140,000 and pay it off in 10 years, you're still going to pay $53,000 in interest, and your payment's $1,600 a month. So you can hardly do anything else but survive and pay your student loan. And if you let it go, then it just accumulates interest, and there's a lot of people in real trouble because they've not done this very well. So you can use that student loan calculator to figure out how much it's going to put you in debt. And it's shocking how much you can go into debt. And so I made a spread. I looked around for a good return on investment. When we talk about financial return on investment, we talk about how I'm going to borrow money now, but what do I get in the future for that? And what could I do with that money other than what I'm doing with it to get a bigger return on my financial investment? So I made a spreadsheet of my own. I couldn't find a good spreadsheet online or a good calculator that would do this, because there's a lot of variables to it. And the esoteric value of an education, if you really want to study a certain subject, understand though, if you go into debt to study a subject that won't give you a good job when you're done, you're going to be in debt. You got to pay it back. And so be very careful about what degree you choose. There's great advantage to having a degree that even doesn't pay you back, but you still have to pay it back. And possibly that kind of education can be had online for free, or you can just read books or do your own thing, and know lots of friends in the same with the same interests, and maybe you don't have to borrow money to get a degree like that. But so is it a financial return? And I'm just going to talk about whether it's financially smart to borrow money to go to college. So I made this spreadsheet, and I try to go through this fairly quickly. I have a nice graph here. I made some bunch of assumptions, and if you made different assumptions, then this would come out differently. So, but this is probably, as far as borrowing money, one of the worst cases you could do. Borrow $31,000 a year. So my investment rate is 7.5%. Now, if you have money and you're going to pay for college, you have to consider what you could do with that money besides go to college. And so I'm saying the person who goes to college, the person who doesn't go to college is still pretty smart and can save at a 7% interest rate. The interest rate on the student loan, 5.5%, that's probably a little dated. The salary, this is a very important number. What salary can you get without a college degree, and what salary can you get with a college degree? In my state, Washington, our minimum wage is $16.28 an hour, and that's $34,000 a year gross. And so you may not have that, and you may not be able to make $30,000 a year right out of high school. But that's probably the case in a lot of states. But for purposes of description here, for my purposes, I'm going to assume some things. I'm going to assume, and this is maybe high for some degrees, it's probably low for other degrees, but I'm assuming I can double my 4 years after, 4 years later when I have my degree, assuming I've graduated, that I can get a high salary with that degree, and that's really what'll pay back the loan. But I want to. The loan is worse than you think it is if you've borrowed a lot for a long period of time. So I'm saying conservative that you can make double the starting salary. I'm saying you work in the summers, and after taxes and expenses get $4,000. So the real cost, so you only have to borrow $31,000 a year, and that's probably on the high side. Hopefully nobody, you don't, with grants and scholarships and help, some kind of help, you can not have to borrow that much money. Most people like to pay a student loan back in 10 years. Sometimes that's not feasible because you can't make the payments. We've seen, the payments are pretty high because you're paying it off fairly quickly. Now, this number is arbitrary, but it's pretty close. This is the percent of your salary saved, including if you buy a house. So in other words, a savings account, a stock market account, and a house are all financial investments, and they can return. So what percent of your salary are you going to put towards that? And if you're able to save up a down payment and buy a house, then that's something that's going to increase in value. So I'm saying the percent of your salary saved, whether you did go to college or didn't, is 45%, and that whether you did or didn't go to college, you can get a 3% raise every year. So this is age 18, and this is the year. And it goes down the years, and we say this is the salary with no college, your net worth without college, then the salary with college, and then your loan payments, and then your net worth with a 4-year college degree. And a big deal is how much that salary is when you've got the degree. If the salary is not much better than you could have made out of high school, then it just never pays off. You're just in debt for a long time, and hopefully this will describe that. So here's your first 4 years of college. If you save 45, that's pretty aggressive to save 45% of your salary. Then you've saved $13,500 the first year of your $30,000, and the next year you have that plus another $13,000 plus interest at 7%. And so by the end of 4 years, your net worth is $75,000. It's either in a savings account, some kind of a savings plan, or you lucky enough to get into a house, and that the value is in your house. So when you don't go to college, you also have some opportunities to do. And if you're good at saving and the other things we've talked about, then you're going to be well off. So here's the red line here is when you go to college, but the salary is $60,000. So it's much bigger than the $33,000 at 4 years later, and that's what you're really going to college for. Well, you can go to college just for the just for the education and because you're interested in something. But I'm talking about the return on a financial investment. Now, here's the bugger: is if you're going to pay it off in 10 years, you got to pay a lot, and you're paying about $19,000 a year. I think that's $1,400 or $1,500 a month, and that's really, if you're gonna, you can make $60,000, but now you got to pay $19,000 back on your loan. So, oh gee, I'm really having a hard time. Plus, and I haven't accounted it for here, but you're in a higher tax bracket here, so you make more money, you pay higher taxes, and so for the first the 10 years you're paying that loan back, it's really hard to say you're getting ahead. If you borrow that much money, which is worst case, I think, for a college education. This is if you didn't work part-time, if you didn't have grants or scholarships, you could end up going $144,000 in debt. Now, I've heard of people, the average debt is more like $30,000 or $40,000, but there are people with over $100,000 in debt when they get through with a 4-year degree. Now, but this is for illustration purposes, really. So you're going to so the person who doesn't go to college can start making money right away. And if they're good at saving, they can accumulate that and do pretty well. And so, but the person who goes to college, you're going to have this initial drop. You're going to go into debt, some amount. And that's your net worth is a negative. And then you take 10 years where this is an upward slope, but your net worth isn't going up by that much because you're having to pay back this loan. And at this point, which is by the time you're age 32, 15 years into this slope changes, and that's because the loan is paid off, and you can take that $80,000. At that time, it's $80,000 with 30% raises a year. And you can now you're breaking even here. You're finally out of negative territory here. And you finally cross the zero line, and your net worth after 15 years, 4 years of college, 14 years, 4 years of college and 10 years of paying back, you're finally at zero. And meanwhile, the guy who didn't go to college, if he's good at saving, he's worth $267,000. But the good news for the college graduate is now this whole large salary minus the extra taxes is going to go toward. Now, it's a mistake to think, oh, I'm making $80,000. I should buy a new car, and I should get some credit cards, and I should buy lots of things, and I should, get a nicer place that I can't afford or something like that. And so if you're going to be silly with money, then it doesn't matter how much money you make. I've heard of a couple making $400,000 gross, they're still maxed out on their credit cards, and they don't own a home, and they don't know where their money's going. They're paying back school loans and all kinds of stuff. So if you're not going to understand the time value of money, then you're probably not going to be making great decisions anyway. So finally, after 14 years, we break even here. We're finally in the positive territory. Now, your higher salary means that the slope of this line as time goes on is higher and higher than the guy who didn't go to college. And finally, we get out here, the break-even point, and this will be different based on what assumptions you make. Down here, we go down to on the table. We finally get to the point where this person's worth $652,000. That's their savings and their house when they're 46 years old. And the person who got out of college finally catches up to them, okay, and is worth the same amount. So they're a crossover. After that, the higher salary of getting a college degree far out, really comes into play. If you're going to work till you're 67, if you do work till you're 67, this person's salary is $127,000. Their net worth is $1.6 million. This person's salary is quite a bit higher, $227,000, and their net worth is $2.2 million. So there's a $641,000 difference if you work until you're 67 in both cases. If you work less than that, the difference is less. Remember, it was even when you were 46 years old, and this final number, quite a big difference, is, and that's really the value of going to college, if you graduate in something that justifies these salaries. Now, this is a tax table. If you don't know, in the United States, income tax, you pay 10% up to $11,000, but up to $44,000, you pay $1,100 plus 12% of the difference between 44 and 11. Okay, if you make over that. So as what you notice is now, oh, I'm doing really well. I'm going to make $95,000. Well, not so fast, because $50,000 of that is going to be taxed at 22%, not 12 or 10%. And so all of a sudden it's a graduated scale. It's not linear. It's very nonlinear. And then, now I'm making even more money, but the tax rate goes up. And finally, people that make a lot of money, they're taxed on the money that's over $174,000. They're taxed on 37%, and there's no limit on that. So, well, I can't relate to that, but anyway, this in the middle here. Now, there's some factors that this spreadsheet doesn't include, and I'm not the expert on this, but you may excel at what you're doing. In either case, without college or with college, you may be really good at it. You may start your own business. And so your personal dedication, your personal hustle, will affect this a lot. And whether you went to college or didn't, and so, that could affect these a lot. Your salary with a degree may not be this high, or it may be higher. I don't know. I guessed $60,000 starting salary. Some degrees have a starting salary. You really ought to research this. If you're gonna, especially if you're gonna borrow money to go to college, it's not just going to college. It's the money you would have made if you didn't go to college, and what you do with it and how you invest it. But you really got to research what the starting salary and average salary and maximum salary is for the degree that you pick, and really pay attention to that and say, wow, I don't know, it's going to take me too long to pay this back. I'll never recover it. Or, yeah, this is reasonable. I can get this done in so many years and be well ahead by the time I'm 67. Your savings rate may be lower or higher. They recommend no more than 28% of your income go towards your housing. And I think that's higher now, maybe 33% or something. And they recommend 20% savings is right. Now a lot of people don't do that, but because you took this course, you are going to do that because you know the time value of money. And but this may be higher or lower depending on how well your discipline is and how much fun you want to have. And you certainly deserve to have fun. So, yeah, and most importantly, if I had this do over, I'd pick a lower number probably for how much you're in debt, because I don't think it's reasonable to think most people are going to go in that much debt. But if you can get scholarships, grants, part-time work, summer work, then you won't have to go into that much debt, and which means this whole thing is easier to pay off. Higher salary means higher taxes. We talked about that, So these numbers look great, but there's always higher taxes when you make more money. It's a big surprise. People get out of high school, they start making money, or they go to college and they start making money, or they create a business, start making money, and all of a sudden, hey, oh, wow, I used to pay not much tax, and now all of a sudden I'm having to pay a whole lot of tax. So let's go back. It's not only about what you spend and what you borrow to go to college, it's about what you could do with the money elsewhere. So, tuition has gone up a lot, but the minimum wage, at least in many states, has gone up at a higher rate than the tuition. Of course, the housing and everything's gone up, and I'm sure it's harder to go to college now than 1976. But it's not a whole lot harder because the minimum wage has gone up, at least in some places. If it hasn't done that in your state, then I'm sorry, but you might go to a less expensive college or anyway. I said minimum wage at $16.28 an hour. That's $34,000 a year. The migrant workers in Washington State get $19 an hour, and it's very hard work, though, And I think they charge them for meals and housing or something. So it doesn't work out that way. But okay, somebody at code.org came up with the return on investment of a university degree by category, and this will be if you haven't picked if you're 18 and you're just picking a major or a career or something to do in life, then this all looks, that's very interesting. It's the same as the time value of money. If someone is saved, like in the previous lessons we had, if someone started when they were 18 and saved a lot, then when they're 50 or 60, they have $500,000 or $1 million or something. And when I have this discussion with people who are 50 or 60, they're very disappointed. This is very discouraging stuff. Like, I wish someone would have told me this, and I was blowing money on all kinds of things, and I could have been saving, and my life could be a lot better later on. And it's the same thing. If I talk to someone who graduated in some of these majors that don't have a high return on investment, then they're pretty discouraged about this. Unless they knew about it ahead of time, and they just say, "Look, I really love a certain thing to do, and it doesn't matter if I have to, spend time doing that. I love that, and you do need to do what you love, but the return on investment is still a fact of life. And if you take these degrees up here, engineering, computer science, mathematics, the physical sciences, if you're interested in that and want to do that, your return on investment over your lifetime is far greater than other degrees. And probably these degrees might justify going into financial debt more than these degrees down here. You may say, anyway. There are alternatives if you want to still learn, but you don't necessarily want to pay to go to a college. There's lots of free online education. The two that I really like is EDX, which is a lot of different universities that have gotten together and offer free courses. You can, for like $50, you can get a certificate, and they'll grade your quizzes and stuff like that, and you can prove that you took the course and passed. And or you can just do it for free. I've done about 4 or 5 at MIT engineering courses. Take a look at this for just a second. I encourage you to go and just look at these courses. These are free online. They're really well done. They show experiments in the laboratory. The professors are really, really good. And the other one is EDX. There's a lot of real top-line universities, MIT, Harvard, Berkeley, Boston, Cambridge, University of Madrid. There's lots of these that are really good. And you can see some of the things that they're offering right now. You can, I think a bachelor's and master's degree cost quite a bit, but you can take the same courses for free. And it's really a great movement that we're getting a free education online. And who knows, if you do it really well, you could end up getting a job or getting into a company and then proving what you're worth and moving up really quickly. So there are alternatives to traditional expensive education. This is one of the last charts, and this is another thing where someone's taken the return on investment and said, there's degrees that you can have a high return on investment, and degrees where you really ought to think about not going into debt. Even if it takes you longer to do it, don't go into debt for a degree that doesn't have a high return on investment. Also, my last question. Well, there's one taxes, but if my grandma was going to pay for I was 18 years old, okay, and my grandma was going to pay for 4 years of college, and I said, well, I want to go to the University of Washington, and I don't have any scholarships or grants or anything like that. It's going to cost $35,000 a year. I don't really want to work. I don't want to, and she says, okay, I saved for this, and I'm going to send you to college. What if I convinced her that, no, don't send me to college. Give me the $140,000. I will not spend it. I will invest it in the stock market. when I'm 22. And I'm not going to touch it until I'm 67 or I'm 50 or something like that. And this is, we can go to calculator.net and say our starting amount was $140,000. Grandma, I'm not going to blow this. I'm just going to invest it. And after 45 years, by the time I'm 67, at a return rate that the stock market traditionally over 100 years has given 10%, how much would I have? You calculate this, you end up with over $12 million. That's the time value of money. $140,000 when I'm 18. When I'm 67, I have $12 million. Probably don't need $12 million. So let's change it up. Let's say Grandma wasn't quite that rich. Let's say that Grandma had $80,000 she was willing to contribute to my education, and I convinced her. And I said, Grandma, I think I want to do this 25 years. Okay? So 47. At 47, how much would I have? Calculate it. Well, it's not as much, but if you were 47 years old and you worked and did this stuff, and I'm 47, and I think, how much is in that stock market account? Gee, $1 million, $964,000 is there. And I can retire and travel or do whatever I wanted to do on that. I just had to wait 25 years for that $80,000 to turn into $964,000. Now, it's not, 10% is probably aggressive. If we change that to 7%, we account for inflation, calculate it, we have $458,000. But still, and that's really worth $950,000 in today's dollars. So, the actual dollars is $958,000. What it'll buy you is what today you could buy for $458,000. That's a lot of traveling. That's just about anything you want to do. So usually calculator.net. So question is, that's a good question. Should I, now most people don't have the money. They don't have a grandma that's going to give them $80,000 or $140,000. So they don't really have this choice. But if you did have the choice, that's what it could mean. You could mean $140,000. And I could wait until I was 67, 45 years later. At 10%, the actual money, $12 million is what you'd end up with. And that's the time value of money. Last thing is the benefits of saving for retirement. Now, if you work for an employer, one of the great benefits for a lot of employers is there's a thing called a 401k, and that is a savings account you can put money into, and you don't have to pay tax on it while you're working. You pay taxes after you start taking money out, after you're retired. The nice thing about it is employers can also contribute 50%. So every dollar you save, you take your check and you say, I'm going to take 10% of this or 20% of it. I think you can't do more than 20%. I'm going to take 20% of my check and I'm going to defer the taxes on that by putting it into a 401k. And so my income's lower, so my tax rate's lower right now. And that just sits there, and I can invest it in different funds usually, depending on how risky I want to be, and or I want to be no risk at all. And then your employer, for every dollar you put into the 401k, many times your employer also puts in 50 cents on that for every dollar. And that's just like free money. If you have this available to you where you work, you have to do this because it's just like getting free money. I'm not sure the options for a self-employed person. They have something like this, but definitely participate in your 401k plan no matter where you work, if it's available to you. These are the federal tax brackets. We talked about that before. The more money you make, the more taxes you make, the higher rate of taxes you have. And we talked about how that works. The first $11,000 it taxed at 10%. And then this money, extra money, is taxed at 12%. Then the money on top of that is taxed at a higher rate. So that's, this is a calculator.net. It's a 401k calculator. So it has how much it has a little form, employer match 50%. So it puts all that in there. The employee contributions, and you can figure this out. Just go to calculator.net and go to the 401k calculator and plan out your future. This person was 30 years old. They expected to retire 35 years later at 65. Their current salary was $75,000. They had $35,000 in their 401k, and they were going to contribute 10% of their salary, and their employee was going to put in 50 cents for every dollar they put in. And what they ended up with at 65 is $1.71 million. $68,000 of that came from the employer. $48,000 came from the 10% they were saving. And the contributions were 5 to 6. The rest of it's in interest. So made over $1 million just on the interest for that. And this is kind of nice because it comes out of your paycheck, the 401k. You don't even notice it after a while, and you don't look at it. You just say, somebody's taken 10 or 15 or 20% of my paycheck. I signed a paper. That's being saved somewhere. I don't even look at it. And then when you turn 60, you start looking at it and you think, oh man, my life's going to be good because I got $1 million in the bank. So that's a little bit about taxes and a little bit about college and whether it's worthwhile to go to college. Sometimes it is, sometimes it isn't. It completely depends on how much you're going to make and what you get out of it, not only financially, but personally, whether it brings you joy in your life. And so next time, the fifth section, we'll talk about needs versus wants and understanding opportunity costs. And that's where you could do one thing, but you could always do something else that might give you a better return on it. And that's the end of session 4. Thanks for listening.